Good evening, everyone. Today we're going to discuss a question that could define the future of wealth preservation, investing, and the global monetary system itself. For years, silver has remained one of the most overlooked assets in the financial world. While investors chased stocks, cryptocurrencies, and real estate, a quiet force continued building beneath the surface. But now the landscape is changing. Economic uncertainty is growing. Governments are accumulating debt at unprecedented levels. Central banks are struggling to maintain stability. At the same time, industrial demand for silver is reaching historic highs as new technologies, renewable energy systems, and advanced manufacturing consume increasing amounts of physical metal. The year 2026 may not simply be another year in the silver market. It could become a turning point that separates those who understood what was happening from those who ignored the signals. The factors aligning today are unlike anything we've witnessed in decades, and the consequences could permanently reshape how the world values silver. In this presentation, we'll examine the forces driving this transformation, the opportunities emerging beneath the headlines, and why many analysts believe silver's biggest move may still lie ahead. Let's explore why 2026 could change silver forever. For decades, governments around the world have relied on a simple formula whenever economic challenges appeared: borrow more money, spend more money, and assume that future growth would eventually solve today's problems. What began as an emergency response during isolated financial crises gradually became standard policy. The result is a global debt burden unlike anything humanity has experienced before. We are no longer talking about billions of dollars. We are no longer talking about trillions in a single country. We are talking about a worldwide debt structure that has expanded to levels that would have been considered unimaginable just a generation ago. Many people hear the word debt and immediately think about personal finances. They think about mortgages, credit cards, car loans, or student debt. But sovereign debt operates on a completely different scale. Governments can borrow vast sums of money through bond markets, issuing promises to repay lenders over time. As long as investors maintain confidence in those promises, the borrowing can continue. The problem emerges when debt grows faster than the economy that is supposed to support it. For years, policymakers believed that economic expansion would stay ahead of debt accumulation. They assumed productivity gains, population growth, technological advancement, and increased tax revenues would make the debt manageable. Instead, debt continued growing at a pace that often exceeded economic growth itself. Each slowdown required more borrowing. Each crisis demanded larger stimulus packages. Each recession brought new spending initiatives. What was once temporary became permanent. The world witnessed a dramatic acceleration of this trend after the global financial crisis of 2008. Central banks and governments stepped in with extraordinary measures to stabilize markets and prevent economic collapse. Interest rates were pushed to historically low levels. Massive liquidity programs entered the financial system. Governments increased spending while central banks expanded their balance sheets. These policies succeeded in preventing immediate catastrophe, but they also encouraged an environment where debt could expand almost without restraint. When borrowing costs remain artificially low for extended periods, debt begins to appear harmless. Governments become comfortable issuing more bonds because interest payments remain manageable. Corporations borrow aggressively to finance expansion, acquisitions, and stock buybacks. Consumers gain access to cheap credit. Entire economies become dependent on easy money. The danger is that low interest rates can create an illusion of sustainability. Debt may appear manageable, not because the underlying finances are healthy, but because the cost of servicing that debt has been temporarily suppressed. The challenge becomes clear when interest rates begin rising. Even modest increases can dramatically alter the financial landscape. Governments suddenly face higher costs to refinance existing obligations. Businesses encounter more expensive borrowing conditions. Consumers experience increased pressure through mortgages, credit cards, and loans. A debt structure built during an era of cheap money becomes vulnerable in an environment where money is no longer cheap. What makes the current situation especially significant is that debt is not isolated within a single country. Major economies across the globe face similar challenges. Developed nations carry enormous sovereign obligations. Emerging economies struggle with their own debt burdens while dealing with currency pressures and economic volatility. International financial systems are interconnected to such an extent that stress in one region can quickly spread elsewhere. History offers important lessons regarding excessive debt accumulation. Civilizations throughout history have encountered periods when debt expanded beyond sustainable levels. In many cases, the resolution followed familiar patterns. Governments devalued currencies. Inflation reduced the real burden of obligations. Financial restructuring became necessary. Wealth transferred from savers to debtors. Confidence in monetary systems weakened. While the modern financial world is more complex than historical examples, the underlying mathematics remain remarkably similar. Debt itself is not inherently negative. Borrowing can support productive investment, infrastructure development, innovation, and economic growth. The concern arises when debt increasingly finances consumption rather than productivity. If borrowed funds generate future economic output that exceeds borrowing costs, debt can contribute positively to prosperity. If borrowed funds merely postpone financial realities without creating corresponding growth, the burden eventually becomes more difficult to manage. Many analysts point to debt to GDP ratios as one measure of sustainability. While no single number tells the entire story, rising debt relative to economic output indicates that obligations are growing faster than the economy's capacity to support them. Across numerous nations, these ratios have climbed significantly over recent decades. Governments continue operating with large deficits, adding new debt year after year. The implications extend beyond government finances. Financial markets themselves have become increasingly dependent on debt-driven activity. Asset prices often respond positively to liquidity injections and low interest rates. Real estate markets, equity markets, and corporate financing structures have all been influenced by prolonged periods of accommodative monetary policy. As a result, reducing debt dependence becomes extraordinarily difficult because so many sectors now rely upon conditions that encourage debt growth in the first place. One reason debt remains a critical issue for precious metals investors involves confidence. Financial systems ultimately function because people trust them. Investors trust that bonds will be repaid. Savers trust that currencies will maintain purchasing power. Businesses trust that financial contracts will be honored. When debt reaches extreme levels, questions naturally emerge regarding long-term sustainability. Those questions can influence investment behavior. Silver has historically occupied a unique position during periods of financial uncertainty. Unlike purely industrial commodities, silver possesses both industrial and monetary characteristics. It participates in manufacturing, technology, renewable energy, electronics, and medical applications while also serving as a store of value recognized for thousands of years. This dual role becomes especially important when concerns arise regarding debt and monetary stability. The relationship between debt and currency creation deserves particular attention. Governments facing large obligations often encounter difficult choices. Raising taxes carries political and economic consequences. Reducing spending can generate public opposition. Defaulting on obligations threatens financial credibility. As a result, policymakers frequently prefer solutions that involve monetary expansion. Central banks can create liquidity, purchase government bonds, and support financial markets through various mechanisms. While these actions may stabilize conditions in the short term, they can also contribute to currency debasement over time. Currency debasement does not necessarily mean immediate collapse. More often, it manifests through gradual erosion of purchasing power. The same currency units purchase fewer goods and services over extended periods. Savers discover that nominal gains do not always translate into real wealth preservation. This dynamic helps explain why precious metals often attract attention during periods of debt-related concern. Gold and silver cannot be created through policy decisions. Their supply depends upon physical extraction, refining, and production processes. While prices fluctuate significantly, the metals themselves remain outside the direct control of monetary authorities. Another important factor involves demographics. Many developed nations face aging populations. As populations age, pension obligations, healthcare costs, and social support programs place additional pressure on government finances. Fewer workers may be supporting larger numbers of retirees. This demographic reality can complicate efforts to reduce debt burdens because spending demands continue rising even as economic growth slows. The global debt challenge is also influenced by geopolitical developments. International tensions, trade disputes, military expenditures, and strategic competition require substantial financial resources. Governments often increase spending to address these priorities, adding further strain to already stretched budgets. Debt accumulation becomes intertwined with national security, economic strategy, and political considerations. Some observers argue that debt levels no longer matter because governments can always create more currency. While technically true in many cases, this perspective overlooks the consequences of such actions. Creating additional currency may satisfy nominal obligations, but it does not eliminate underlying economic realities. The purchasing power of that currency remains subject to market forces, confidence, and supply-demand dynamics. Inflation serves as one mechanism through which debt burdens can be reduced in real terms. If prices rise while debt remains fixed, the real value of obligations declines. Debtors benefit because they repay obligations using currency that possesses less purchasing power than when the debt was incurred. Creditors and savers often bear the cost through reduced purchasing power. Over the past several years, inflation has returned as a major economic concern in many regions. Consumers have experienced rising costs across food, energy, housing, transportation, and essential goods. While inflation rates fluctuate, the experience reminded many people that purchasing power cannot be taken for granted. Debt-heavy systems often struggle to combat inflation aggressively because higher interest rates increase debt servicing costs. This creates a difficult balancing act. Policymakers must control inflation without triggering financial instability. They must support economic growth without encouraging excessive borrowing. They must maintain confidence while addressing structural challenges that have accumulated over decades. These competing objectives rarely align perfectly. For silver investors, the significance lies in understanding the broader context rather than focusing exclusively on short-term price movements. Silver's long-term value proposition is connected not only to industrial demand, but also to monetary conditions. If debt pressures continue influencing policy decisions, the environment supporting precious metals may strengthen over time. Market participants frequently underestimate how quickly perceptions can change. Financial systems may appear stable for extended periods before sentiment shifts. Confidence can remain strong until specific events expose underlying vulnerabilities. When investors begin questioning sustainability, capital often seeks alternatives perceived as stores of value. The debt issue is particularly relevant because it affects nearly every aspect of the modern economy. Interest rates influence housing markets. Government borrowing impacts bond markets. Monetary policy affects currencies. Corporate debt shapes business investment. Consumer credit influences spending patterns. These interconnected relationships create complex feedback loops that can amplify both stability and instability. Silver's historical role becomes especially intriguing in this context. For centuries, silver functioned as money across civilizations. Long before modern central banking systems emerged, silver facilitated trade, preserved wealth, and supported economic activity. Although today's monetary systems operate differently, silver's legacy continues influencing investor psychology and market behavior. The possibility that 2026 could represent a pivotal year stems from the convergence of multiple trends. Debt levels remain elevated. Fiscal pressures continue expanding. Interest rate dynamics remain uncertain. Industrial demand for silver is growing through technological transformation and energy infrastructure development. Supply constraints are becoming increasingly visible. These factors do not exist independently. They interact with one another in ways that may reshape market expectations. When examining debt, it is important to recognize that crises rarely emerge solely because debt reaches a specific numerical threshold. More often, problems develop when confidence in future management begins deteriorating. Investors become concerned about sustainability, borrowing costs increase, financial flexibility decreases. Policymakers encounter fewer options. The transition from confidence to concern can occur gradually or suddenly depending on circumstances. The world today faces questions that previous generations also confronted in different forms. How much debt is sustainable? Can economic growth outpace obligations indefinitely? What happens when borrowing becomes the primary solution to every challenge? How do governments manage competing demands without undermining financial stability? These questions remain central to understanding the economic environment that may shape silver's future trajectory. As debt continues expanding across major economies, investors, institutions, and policymakers increasingly find themselves navigating a landscape where traditional assumptions are being tested. The outcomes remain uncertain, but the scale of the challenge is difficult to ignore. The global debt crisis is not merely a headline or a temporary concern. It represents a structural force influencing monetary policy, investment decisions, currency stability, and the search for assets capable of preserving value in an increasingly complex financial world. For many years, silver was viewed primarily through the lens of investment demand. People discuss silver as a precious metal, a hedge against inflation, a monetary asset, and a companion to gold. While those characteristics remain important, a profound transformation has been taking place beneath the surface of the global economy. Silver is no longer just a metal investors buy during times of uncertainty. It has become an essential industrial resource powering some of the most important technologies of the 21st century. This shift is one of the most significant developments in the silver market, and it is reshaping the balance between supply and demand in ways that many investors still do not fully appreciate. What makes silver unique among precious metals is its remarkable combination of physical properties. Silver is the most electrically conductive metal known to science. It is also the most thermally conductive and among the most reflective materials available. These characteristics make it exceptionally valuable in industries that depend upon efficient energy transfer, precision electronics, and advanced manufacturing. Unlike many commodities that can be substituted relatively easily, silver often occupies a critical role in applications where performance and reliability are essential. The modern world runs on electronics. Smartphones, computers, servers, communication networks, industrial automation systems, medical devices, and countless consumer products rely on components that require highly conductive materials. Silver is frequently used in electrical contacts, circuit boards, switches, connectors, and specialized electronic applications. Every year, billions of electronic devices enter the global marketplace, each containing small amounts of silver that collectively create enormous demand. Many consumers never think about the silver hidden inside the technology they use every day. When someone sends a message from a smartphone, streams a video, accesses cloud services, or operates a computer, they are indirectly benefiting from silver's unique conductivity. Although the amount used in any individual device may appear small, the scale of modern electronics production transforms these tiny quantities into substantial industrial consumption. The rise of artificial intelligence infrastructure is creating an additional layer of demand. Data centers require massive amounts of electrical equipment, power distribution systems, networking hardware, and cooling technologies. As companies expand AI capabilities, build larger computing clusters, and increase processing capacity, the demand for highly efficient electrical components continues growing. Silver's conductivity makes it valuable in many of these applications, particularly where performance and energy efficiency are priorities. Perhaps the most widely discussed source of industrial silver demand comes from the renewable energy sector. Around the world, governments, corporations, and consumers are investing heavily in solar energy. Solar panels require silver because it plays a crucial role in conducting electricity generated by photovoltaic cells. Each solar panel contains silver paste used to collect and transport electrical current, while manufacturers continually work to reduce silver usage per panel. The overall expansion of solar installations has often outpaced those efficiency gains. The scale of the global solar transition is extraordinary. Nations are setting ambitious renewable energy targets. Utilities are expanding solar capacity. Businesses are investing in clean energy infrastructure. Residential solar adoption continues increasing in many regions. Every new solar installation contributes to silver demand. As the renewable energy sector expands, it creates a consistent and growing source of industrial consumption that did not exist at today's scale just a few decades ago. Electric vehicles represent another powerful demand driver. The transportation sector is undergoing a significant transformation as automakers invest billions of dollars into electric mobility. Electric vehicles require complex electrical systems, power management components, battery technologies, charging infrastructure, and advanced electronics. Silver is used throughout many of these systems because of its exceptional conductivity and reliability. An electric vehicle typically contains more silver than a traditional internal combustion vehicle. As production volumes increase, the cumulative effect on silver demand becomes increasingly important. The impact extends beyond the vehicles themselves. Charging stations, grid upgrades, energy storage systems, and supporting infrastructure also contribute to industrial silver consumption. The transition toward electrification creates an ecosystem of demand that stretches across multiple industries simultaneously. Modern power grids are also evolving. Aging infrastructure in many countries requires modernization to accommodate renewable energy integration, electric vehicle charging networks, and increasing electricity consumption. Smart grids depend on advanced sensors, communication systems, control technologies, and power management equipment. Silver frequently appears in these applications because of its electrical performance characteristics. As governments and utilities invest in upgrading energy infrastructure, silver demand benefits from these long-term projects. Medical technology represents another important source of industrial demand. Silver possesses natural antimicrobial properties that make it useful in healthcare settings. It is utilized in wound dressings, medical instruments, specialized coatings, water purification systems, and various healthcare applications. Advances in medical technology continue creating new opportunities for silver usage. As healthcare systems expand,